you're very welcome to this week's podcast 357, where we're talking about the standard fund threshold, which may or may not apply to you, but hopefully it's interesting one way or the other. If you are funding hard into a pension, this might apply to you in the future. If you're approaching retirement in the near future and you have accumulated significant defined benefit schemes and or defined contribution, PRSAs, occupation scheme, executive pension schemes, buyout bonds, heading for the 2 million figure, then this is for you, and I hope it's going to be of some value to you. The standard fund threshold is going through changes. It is increasing, which is a positive. Is it increasing at the rate some people want it to? Probably not, but it is increasing and it's a positive. Okay, so I'm going to talk about what's changing, how to calculate it, the impacts for defined benefit schemes and for defined contribution schemes, what it means if you have a transfer value from a defined benefit to consider, and also how to do some calculations and the tax planning opportunities that might apply. An awful lot to cover. Going to give some headline figures and some guidelines and some guidance. But of course, please do your own research and get qualified professional help before making any decisions, because this is a bloody biggie. Okay, here we go. The standard fund threshold has been stuck for 10 years now. Right, since 2014, it has been stuck at 2 million. Any pension fund value above that limit is classified as a chargeable excess, an excess above that 2 million figure, and attracts a 40% haircut at the time of crystallization. Okay, called a chargeable excess tax, or CET. We love our acronyms, so there's plenty of them coming at you today. If you have a defined benefit scheme, for argument's sake, and your defined benefit annual statement is showing an annual income in retirement of, let's say, 80,000, you're thinking, happy days, there'll be tax to pay on that or whatever, but that's fine. This excess tax could reduce your quoted defined benefit income quite significantly. So you don't actually receive the quoted gross income. You receive that minus a haircut gross. And this is variable depending on the years in which you accrued your defined benefit scheme, because there's different factors and calculations, the years you accumulated and your age, etc. So there is a calculation to be done to determine what your equivalent annual income is worth from an SFT perspective. In the case of non-defined benefit pensions, so everybody else, occupational schemes, executive schemes, PRSAs, ARFs, BOBs, buyout bonds, PRBs, again, that's an acronym, an alphabeti spaghetti. Is that the term? Alphabeti spaghetti? Something like that. Anyway, when these excess funds are drawn down from a scheme, they will also be most likely subject to income tax, of course, right? But once you crystallize assets over the 2 million, increasing now, of course, is 2.2 million now. But once you crystallize assets during your lifetime in excess of the current SFT, you will pay 40% haircut at source on that, and then exit tax, or I beg your pardon, income tax when you're drawing down the benefits. And that's where this often quoted 70% plus tax is calculated by. They're talking about the 40% CET plus income tax, or the total effective rate on income tax when you're drawing down the assets. And it's a bit of a headline figure. It's not really always the case, right? Because it assumes that you draw down the entirety of your pension pots before you pass away, etc., etc. But certainly 40% CET is a nasty bill to pay. Okay, so understanding where this SFT came from very, very quickly. The SFT was introduced in 2005, so 20 years ago. And believe it or not, 20 years ago, the SFT was 5 million. 20 years ago, the SFT was 5 million. Then in the doldrums of the 2010s, it was reduced to 2.3 million. Then cut to 2 million in 2014. when we were in really dire straits, to be fair. So that's when it changed, and it ultimately increases the tax take, okay? But it has remained at that 2 million despite an awful lot of lobbying and consternation for over a decade. And indeed, it really came about, if you recall, a couple of years ago when this, public service, public sector couldn't fill particular roles and particular salaries. And ultimately, it was a case from the individual's perspective, it was like, well, and there in a DB scenario, if I take this increase in salary, my retirement income and pension, my DB income will increase, but this SFT is just going to kill me. So the net value or benefit to them in taking these promotions and filling these really, really important government roles was eroded from a financial perspective. Right. So they had to do something about it ultimately. And so it wasn't a case of, hey, we're nice and we want to do everything for something for everybody. Really, they really needed to do it. Okay. They really needed to increase it. So that's ultimately where this stemmed from. So in the last few years, the government engaged Dr. Donald de Butler, and I have a link in the blog. If you go to informeddecisions.ie, you can go to the blog page. You'll see links to some of the articles, and in particular, or you Google it, Dr. Donald de Butler SFT review. It'll pop up and you can read the full report. On the back of that, the SFT is increasing 200,000 per year from this year through to 2029. So in 2029, the SFT will be 2.8 million. Okay. And from 2030 onwards, the SFT, they're saying, will rise in line with average earnings growth based on CSO data. So 2.8 will be index linked going forward in line with average earnings growth. So that would be interesting to see what kind of rates it will grow at from there. And again, this is with a view to keeping it in line with realistic growth over the years. Can certainly, as a country, you would imagine we can afford to do this. In case, of course, it's a case of balancing the books, but it is equitable to have the SFT rise in line with average earnings growth, one would imagine. So 2026, the SFT is 2.2 million. I get to the nuances around, well, it's actually slightly more in practical terms in some scenarios in a little while. 2026, 2.2 million, 2027, 2.4 million, 2028, 2.6 million, 2029, 2.8 million. So if you plan to start drawing your pension benefits from 2029 onwards, you're heading towards a kind of a total effective pension pot values of 3 million, thereabouts, right? Just as a kind of a broad gauge one can work on from the current 2 million, which again, kind of broad range. Or sorry, 2.2 as of 2026. Keep forgetting we're in 2026. So they say, look, they did this out of necessity, but it's saying, they're aiming to better reflect current salary levels and investment growth and inflation, all which factor into this. So, as I said, if your pension fund or values are deemed to be in that kind of a range, then you need to start thinking about this, all right? The impact of this can be quite significant. And indeed, these increases, which have started now, how does that impact if you've partially drawn some benefits in the past and you're going to draw more benefits in the future? This is often misunderstood in a phased kind of a drawdown scenario. So to start, when you access particular pension benefits, when you turn them on, as in take a lump sum or start drawing income from them, you are doing what is called benefit crystallization. So if you trigger a pension pot, take a lump sum or start drawing income, you have had a benefit crystallization event, a BCE. More acronyms. Benefit crystallization event. Yes, indeed. Have you had a benefit crystallization event? If so, speak to your doctor. But ultimately, if you have a BCE, that is a portion of your threshold used up. Okay, so let me explain. For example, and this is whether it's you've turned on a DB pension or you've taken a tax-free lump sum from a PRSA or you've started drawing annual income from a DC pension pot or an executive pot, whatever it might be. Let's say you retired a PRSA or a PRB pot valued at 480,000 in 2025. Okay, so you had this standalone pot from previous employment or whatever it was, and you had a BCE on it. So you triggered that pot in 2025. So last year, in that, the standard fund threshold last year was 2 million. So you used 24% of the 2 million SFT in that year. So what that means, as the threshold increases, you still have 100% minus 24, you have 76% of today's SFT threshold to use up. Okay. So as the SFT has now increased to 2.2 million in 2026, you've used 24% of your SFT. You have 76% of SFT remaining. So 76% of 2.2 million is 1.67 million of threshold remaining this year. So in that scenario, you can crystallize or draw down on 1.6 million of pension pots, okay, or equivalent DB income in 2026 without getting hit with any further or without any chargeable excess tax. Whereas, so that's if you did it this year. So let's say you have 1.67 million of another separate PRSA that you want to draw down on and you want to do it this year, you can do so and there'll be no CET, no excess tax. But we know the SFT is increasing to 2.8 million over the coming years. If you delayed the drawdown of that 1.67 million pot till 2029, in which case, at which time you still have 76% of threshold unused, but it would be 76% of the 2029 SFT, which is 2.8 million. So 76% of that is 2.12 million. So that PRSA, in theory, could grow to 2.1 million. You then trigger that pot, as in start drawing down, it'd be 6%, right, at that time, or take a tax-free lump sum from that one if you haven't already taken tax-free lump sums, etc. Whatever. You crystallize, you mature, you start drawing down on it. You have a ceiling of 2.12 million on that one. So almost an additional 500,000 of pension benefits with no chargeable excess tax liability by waiting until 2029. So this proportional approach is sold to us, allowing those with earlier withdrawals to still benefit from later increases on future pots, potentially reducing or eliminating excess tax on subsequent pension fund drawdowns or income being turned on. And that does apply to quite a few people. Again, not everybody is going to be impacted by the SFT. They are big numbers, but there's an awful lot of people that it would have made sense for them to turn on incomes in the past for whatever reason, but they have other benefits that they might not need right now and that they will use in future. So there's often some really, really good opportunities and planning opportunities around that. What is not changing? So the lump sum withdrawal limits are not changing. So the rules around retirement lump sums are basically staying the same, right? So you can still take up to a max of 500,000 lump sum in total from pension assets. So if you have 2 million or more total pension assets, you can take up to 25% as a lump sum, which is 500,000. 500,000 is the max. The first 200,000 of that is a tax-free lump sum, with the next 300,000 taxed at 20% rate. Importantly, under changes introduced in the Finance Bill 2024, this 300,000 band is now fixed. It's not increasing in line with the SFT beyond 2029. It's not index linked with salary growth. This means that while pensions pots can grow larger before triggering CET, the treatment of lump sum withdrawals remains exactly as it is today, which is a bugger, to be honest with you. Right? Why isn't it increasing? What the bloody hell? What's the logic for that? Again, it all comes down to tax take, right? If you think about it, and keeping things simple and round, maybe, I don't know. The CET will remain at 40%, right? Despite Dr. de Boutler recommending it reduced to 10%. And the government has committed to reviewing this rate again in 2030. There's no guarantee of action on that, of course. And I guess it's very much dependent on the political and economic wins at the time. But 40% is absolutely punitive. Somebody's a really diligent saver and they happen to get fantastic gains and growths on their funds due to accumulation and smart investing over the years. They're punished 40%. If you have, say for argument's sake, you have pension pots of 3.2 million today, right? In 2026, that's $1 million over the 2026 SFT. And just for simplicity's sake, let's say you crystallized it all to this year, you're $1 million over the threshold. 400,000 of it is paid by the trustees to the revenue on crystallization. They have to do that. 40% of the excess, and there's some slight workings around that, but 400,000, 40% of the excess paid to the revenue. So now, instead of a pot of 3 million, you're talking about your options on a pot of 2.6 million in terms of generating tax-free lump sums and moving to R for annuity, whatever the case, right? So it's bloody punitive. It's an outrageous rate, and really should be something done about it, I believe. There is a slight working nuance around calculating of the CET when you're taking more than 200,000 of a tax-free lump sum. Okay, and here's how it works. If you take more than 200,000 of a tax-free lump sum, and again, you have to have a pension pot to be eligible to do that, 25% of the pot, or if you have a DB or an occupational pension scheme, and you're going down the salary and service route, slightly different calculation. In the interest of simplicity, you're taking 200,000 tax-free lump sum. There's no taxation on that 200,000. If you take more than 200,000 lump sum when you're triggering a pension pot, you would pay 20% on any amount that you decide to take over 200,000, and that's taxed at 20%. Okay. So in the scenario, you have 2 million pension assets in a PRSA, and you opt to take 25% of that pot today. You're taking 500,000, which is the most that you can take, as hopefully clear. You're paying 20% tax on the 300,000. Okay, that's a 60,000 tax bill, 6,000 euro tax bill. Okay, that 60,000 can be used to offset chargeable excess tax, which is 40% rate on up to 150,000 excess fund value, if I'm explaining that. Okay, so in essence, this effectively increases the amount you can accumulate before paying additional tax. So in 2025, the SFT was 2 million. Okay, the effective SFT with lump sum tax offset was 2.15. So it's 150,000, because you can basically write off 150,000 of excess, because that results in a 60,000 CET bill if you're taking the additional 300,000, if I'm explaining that okay. And I might have made a dog's dinner of that, but hopefully that is clear. 2026, the effective SFT, if using offset, is 2.35 million. 2027, it'll be 2.55. 2028, 2.75. 2029, 2.95. So essentially it's 3 million. That's where we're at. Okay. And in that scenario, again, this year, you're not going to have an issue with CET if you're crystallizing 2.2 million or under. So in that example, I should have really said 2.5 million. You're taking 500,000 of a lump sum, which is the max you can take, even though that's less than 25% in that scenario. But that does result in a CET. So that's how you can work that particular thing. What about when it comes to defined benefit? Because it's often misunderstood. Well, with a defined contribution, it's very clear. You can see the value, right? Whereas a defined benefit, you're looking at an annual income. It's like, well, what the hell am I meant to do with this? How do I know if I'm anywhere near the SFT? Well, there's a calculation that'll be done. Trustees will do that for you if you ask them what is your SFT figure, where you're going to be based on projections and where your DB is at, because it's done on a factor calculation, which is usually 20 up to certain years. Lump sum is included, and the visibility with a DC scheme in terms of how near or far you are from the SFT is very, very clear. With a DB, it's much, much less visible. So the surprise of you having a SFT breach is much, much higher with a DB than with a defined contribution or a PRSA or anything other. Unless, of course, your returns double your fund value in a year or something, which doesn't ever happen. But that SFT breach for defined benefits is a particularly big one. As I said, with a DB statement, you get an annual statement every year, and it never mentions that, the quoted defined benefit income will be slashed if it exceeds the SFT, right? And chargeable excess tax that will be applicable. But this is a risk, particularly if you decide to take the full DB income and not take a tax-free lump sum. Again, depending on your figures entirely, right? But that should be figured out. Ask the question of your trustees: what's the impact of SFT, if applicable, on my projected DB income? That's the question, and they should be able to advise accordingly. They might laugh at you and say you're nowhere near it, pal. Forget about it, back in your box. Fine, right? But if they're saying, hey, based on your projections, where you're going to be in a few years or in 10 years' time, it's something that needs to be potentially considered. Again, fine. You may or may not do anything about it, but it's just to know that what you're looking at is or isn't actually what you will be looking at in your bank account, or at least on your pay slip when you are drawing retirement income. What about when it comes to defined benefits and transfer values? This is a big one for people. Say you have a DB scheme that is quoting you annual income of 90,000 per year. Okay. And again, that's a big, big number. You might want to have been in a company for many years and earning, as I said, big income to warrant that kind of a DB income. But let's say upon investigation, for argument's sake, you discover that based on your own unique circumstances and calculations and factors, this 90,000 will, put you well in excess of the SFT, resulting in a reduced DB income of 75,000 gross per year, right? Just for round numbers. So you're saying, geez, right? So, okay, so instead of 9,000, I'm actually going to get 75 gross less tax. Okay, that's not exactly what I was thinking, nor what my statement had been showing me. Then they also offer you a transfer value, right? But they say, hey, go away, sell us your defined benefit pension, and we'll give you 2.1 million of a transfer value, for argument's sake, which is approximately 19 times the annual income. And you say, well, geez, I hope to live longer than 19 years. And there's a big decision here. But let's just say, for argument's sake, that's the numbers that they gave you. Not amazing transfer value, solid and broadly in line, right? Plus or minus a few years, what you might see out there. That that transfer value does not reach nor exceed the SFT, which is positive. It gives the option to move the full value to PRSA or multiple PRSAs, allowing for a sequence drawdown, potentially positive for flexibility and legacy planning. It also then gives the option to take up to 500,000 lump sum from PRSAs, again, positive potentially, and invest any balances in an approved retirement fund, or indeed buy an annuity with some or all of the balance, again, positive, potentially, subject to annuity rates being decent at the time. The full value of the PRSA or ARF essentially passes to your partner or estate on your debt, which is, broadly speaking, a positive and a big thing for people when it comes to all of this. There's some potential massive tax income and estate planning positives, but there are also potentially some massive negatives too, right? So negatives are, yes, you would potentially avoid getting a CET, SFT haircut, but you'd need to get your head around all of a sudden not having a defined benefit or guaranteed income if you went down the ARF route or PRSA routes. If you're using PRSA or ARFs as well, exposure to market swings, assuming you invested in some sort of assets for the long term, potentially negative long-term outcomes if what you invest in doesn't work out for the long term and isn't carefully managed and monitored. Additional costs and administration of drawdown from ARFs and PRSAs, etc., usually requiring a financial planner on board. Who doesn't want to go to one of those, right? But it's a huge decision, and it's one that some are nervous and will absolutely avoid entirely because it's such a big decision, potentially having such a big impact one way or the other on them and their family's financial future. So it's a big, big one. But defined benefit schemes do interact with the SFT. It's not that visible. You don't really get to see it or crunch those numbers until the end when you're starting to draw stuff and making that decision. So it's a big, big consideration. So what else should you consider now? And I'm conscious of time. If your pension benefits are approaching or projected to approach or exceed 2 million, ultimately, the sooner the better getting your head around it and understanding where you're heading and what might be the implications, positive or negative, and how might that present opportunities or threats for you. How might the upcoming changes and your potential options with regards to your own scenario give flexibility, potential tax advantages, and understanding how can you potentially capitalize on some of those advantages. I think the considerations should include the likes of projecting your pension values across all arrangements to understand when and if you might breach that threshold. And if I do X, will it? And if I do Y, will it? If I make these contributions, should I still contribute? Or, if it's just on growth, then that's okay, isn't it? And again, that's my general feeling. If you're not actively, massively contributing to a scheme and you're going to exceed the SFT, well, if you're not contributing, then it's just tax on growth. It's tax on growth that you'd prefer wasn't there, but it's just tax on growth, assuming you get the growth, right? Timing your decisions around retirement and benefit crystallization, having those crystallization events over a phase period, how does that actually work? Coordinating multiple pension pots, considering your legacy planning. Well, if I draw those pots and then I don't draw those pots, then if something happens to me, then that will go to my spouse as cash or whatever. Opportunities, understanding the interaction between lump sum taxation and CET offsets. Looking ahead, right? The SFT changes do mark a welcome and overdue update, to be fair, to Ireland's retirement planning framework and structures and opportunities. Take time. If you think and if you believe it is going to impact on you, then take the time to understand it. Figure out what you might need to do or not. Engage somebody decent. You can go to the trustees of the scheme. They are usually a good place to start to get the data, get the information. They may be really, really good at giving you guidance. If not, look outside, go and hire an independent financial planner or somebody who knows this stuff and can help you figure it out. That's worth the investment of time, effort, and money to get a decent view and guidance. That's about it from me. Said you could talk about all the different nuances of this all day, but we've all got lives to go about. So thank you very much indeed for listening. Yeah, you're a legend.